Moving on with our project, under the third part, specific data to look for when analyzing major economies, and it is time for the core CPI in Canada. Now CPI stands for the Consumer Price Index, and it is being called a core CPI because the volatile elements of the CPI are disregarded in order for the value not to be distorted. The CPI is the measurement for inflation, and inflation is on the mandate of every single central bank in the world. So a typical mandate calls for keeping inflation below or close to 2%, and rising values in inflation or lower values in inflation normally signal shifts in the monetary policy, and shifts in monetary policy made by central banks translate in volatility for the currency market, as the currency is going to move based on that information. So this is one of the most important indicators in terms of volatility that is being brought to the market. And not only, given the fact that the equity markets and the overall markets react the most at anything that is related to inflation. And this is the favorite measurement for inflation. Hence, high levels of volatility surround the release. Usually, central banks favor the core CPI, like it is the case here, as you can see, core CPI in Canada, as it shows the change in goods and services purchased by consumers, excluding food and energy. And the reason for this is that food and energy prices tend to be extremely volatile, and they are distorting the real data. So while the CPI number includes food and energy, the core CPI indicator is mostly watched by traders, as it shows the real inflation levels in the economy. However, in the case of Canadian economy, the core CPI indicator shows the change in goods and services purchased by consumers, excluding the 8-month volatile items. And it's a bit different than the one calculated in the United States and even in Australia, as a matter of fact. Inflation is important for traders because rising prices lead to central banks to increase interest rates, and this translates to higher volatility levels in the markets. The most important things to take into consideration when looking at the core CPI indicator in Canada are the following. The release date, first of all, monthly, about 20 days after the month ends. The release time, 12:30 GMT during the North American trading session, and this one is the first tier data. So if you're looking for something to move, then look for the moment the core CPI is released to the market, and moreover when the actual differs most from the forecast. It is released by Statistics Canada, and it shows the change in the price of goods and services purchased by consumers, excluding the 8-month volatile items. Now, volatile items account for about a quarter of the CPI. Okay, so 25% of the CPI is being represented by the volatile items, but they tend to be very volatile and distort the underlying trend. Therefore, the Bank of Canada pays most attention to the core data. So do traders. This is among the few non-seasonal adjusted numbers reported on the calendar, as it's the calculation most commonly reported. Consumer prices account for a majority of overall inflation, and this is why traders care, this is why this is important, and this is why central banks are keen to cap inflation level. Inflation is important to currency valuation because rising prices lead the central bank to raise interest rates out of respect for their inflation containment mandate. Remember, the mandate, a regular mandate, calls for keeping inflation below or close to 2%. The core CPI is being released on a monthly basis about 20 days after the month ends, 12:30 GMT during the North American trading session, first tier data. CPI equals inflation, so you might look for the inflation release when the CPI is coming to the market. extremely volatile data, first tier economic data. Things are moving under this release, and it is watched with interest by all traders and central bankers. Looking at the past 6 months worth of data for the core CPI, starting with February 2013 and ending with July 2013, as you can see, only positive prints for the month between February and June, starting with 0.1, 0.2, 0.8 for April, and then 0.1, 0.2 into the positive territory, and all of a sudden, for whatever the reason, in July you are having minus 0.2 for the core CPI. Remember, this is the data that is not distorted. The volatile items are being excluded. So negative inflation for the CPI in Canada translates in deflation dangers. This is a deflationary territory, and this is by far more dangerous than inflation. So Bank of Canada now, what needs to do is to definitely trying to ease again to keep easing the monetary policy in the way that inflation, not only that is not a threat, but it is going into the negative territory, and this is quite dangerous. As a matter of fact, take a look at Japan, what's happening there in the last decade, and you'll have the answer. The next indicator to look for is the core retail sales, that we are approaching the end of the Canadian analysis. But before the core retail sales, let's go back to try to end with the most important thing to take into consideration when looking at the CPI, the core CPI. The release date monthly, about 20 days after the month ends. Release time is 12:30 GMT during the North American trading session. First tier economic data, extremely volatile. CPI equals inflation. Let's move on now with the core retail sales in Canada.